We're here. We're finally here. It's first call. You're watching Tasty Live. I'm your host, Chris Vecchio in New York. We'll be joined by Ilya Spivak in San Francisco shortly. Having some fun here with some technology issues. I think some folks in the chat are noting that too. We are working on it right now. It's going to be resolved quickly because, you know what, we got to get these markets open. It's 6 Eastern, 5 Central here. We are looking at what should be a pretty exciting week in markets. For everyone joining us, welcome to the show. If you're watching on the platform, of course, thanks for coming onto the platform if you're able to get on. If you can't, well, come over to YouTube. If you're there on YouTube, thanks for being here. Tell us what you think of this upcoming week, what you think of this start to the year. Stocks had a pretty good start to the year. The S&P 500 closes out last week at a fresh all-time high. We saw similar highs put in place for the Dow Jones, for the Russell. The NASDAQ continues to lag, which deja vu. That kind of happened at the beginning of last year, going into March as well, where the S&P 500 was putting in relative new highs while the NASDAQ could not really accomplish the same thing. So a divergence that may be worth noting. I do see that we're joined by Ilya here. Ilya, finally, the Rube Goldberg machine that we use to keep everything on around here finally is kicking in. I'm always reminded of that early 2000s Sports Center commercial where the anchors are, you know, they're sitting in the studio and the lights go out, and so they go down to the basement and like Lance Armstrong's there on a bike and he's just taking a break, and because he's not pedaling, the electricity is no longer flowing to the rest of the studio. So we probably got to get on that. But Ilya, it's an important week coming up here, right? I see, and yeah, Ilya, Paul, Josh, Ilya's here. Yeah, there's the guy.
There it is.
Important week coming up. CPI coming up on Tuesday. We have a bunch of earnings releases. The banks are in full focus, and they have been a bright spot in the market for the past several weeks. Before we get there, though, let's talk about the start of this year and what we really should be anticipating. Stocks off to a strong start. Metals continue to run. Obviously, geopolitics are in play. Mm-hmm. What do we make of the volatility here at the start of the year? That's really where I want to start as opposed to any particular price action. The VIX closes out at a new low, 1448. We can go out to the volatility futures here. We can go out to the front month contract, and you see here that it's declining. And then in the second month contract, we go out to what would be the February expiry, and that's sitting at a new cycle low. No vol, limited participation. Let's talk about the start of this year.
Well, I think when you look at what's going on against the backdrop of this relative to sort of what the progression is in indexes, there's obviously some sort of a disconnect here, because you're right. The move in volatility futures here is very clearly of a kind. It's very clearly giving you a sense that there's just not this perception of something going wrong, and yet you're not seeing a parallel situation occurring in the indexes. They're not exactly powering higher. We finally got a breakout in the Russell on Friday, but we're still pinned under the highs on the S&P. We're not even close to the highs on NASDAQ. So when we look at all of this, we say, okay, well, what's this volatility crunch telling us? Is it telling us that there's not conviction, or is it telling us that there's not concern? And I think the larger issue is there's not conviction. People don't want to bet. And you see that in the rising term premium in the US 10-year Treasury bond, which at this point, we've been talking about this for the past week. It's at the highest since 2014. So there's clearly a desire in the market to get paid for duration risk, and that smells like uncertainty. The market does not want to find out that it was complacent. And maybe this vol crunch isn't so much telling us that nobody's worried, but tells us that nobody wants to take a punt on what the future actually holds.
We do have some opening quotes coming through here, Ilya, and while we're still facing some issues on our side, I can tell you that the S&P is down by, we'll call it 11 points, 69.55 here. Yeah, these are all the CFDs, so they're getting a little bit of liquidity. NASDAQ tracking lower by about 0.2%. Russell down by 0.2%. Dow Jones off by 0.2%. Volatility here still trending lower. Really nothing to be seen thus far. Obviously, one of the pieces of news that we were watching at the end of last week would be potentially a revival of oil volatility and oil
Yes.
potentially starting off this week out of the gate a little bit stronger. Some protests in Iran are girding up and potentially bringing back a deja vu itself of what happened last April, May, June. Remiss to say that our friend of the show,
It'll be a deja vu what happened in 1979, just the other direction.
Yeah, well, friend of the show, Ayatollah, has not responded yet to any of our inquiries.
Is he a friend of the show? Has he expressed anything like?
Why does he follow me?
It's a good question.
I assume if you follow me on Twitter, we're like kind of friends. That's how the internet works.
I mean, at least friends of the show.
Friends of the show. Okay, so
at least friends of the. Fair enough. Ayatollah Khomeini, a friend of the show. I'll take it.
So we have 59. Terrible. It's what they're doing right now in the streets. The protests there are spiraling out, but this, feels a little bit different, particularly unlike other episodes of unrest in Iran, where the U.S., Europe has more or less just been a passive observer. There are more U.S. military assets over the weekend moving into the region, not so different than what we saw in the buildup last spring. So maybe the U.S. is going to get involved with hitting Iran while they are weakened and focusing on domestic turmoil, so as if to further handicap the nuclear facilities and efforts.
Let me try a theory on you.
Excuse me?
Let me try a theory on you.
Well, before we get to the theory on me, let me test this on you.
Yeah. Okay.
Are we worried about this run-up like we saw last June? I mean, is there a possibility for oil to have another outlier event? And given where it's been trading already, is that going to set up another effort to potentially short a geopolitical squeeze here in the coming days and weeks?
I think it might be both, but I think you might need to be extra careful about fading any kind of geopolitical squeeze here. And this is the theory I wanted to test out on you. I think maybe this could be more than just a geopolitical squeeze. I think what we saw last time was a firefight between Israel and Iran, where neither side really wanted the firefight. Neither side really wanted to come to blows directly. They've been doing everything they could to avoid it. And there were a few inevitable exchanges there. Obviously, things escalated with the strike on the nuclear facilities. But there's one set of circumstances there. There might be a longer term set of circumstances here. China is losing its oil suppliers and is coming to a place where Russia is going to start being the only game in town. That's not a good place to be. Where Russia is your single point of energy supply failure, that's a nation at war and increasingly shaky economically and increasingly getting squeezed for how it can actually transport and send these tankers, these shadow fleet tankers. We appear to be starting to board those. And so when you look at what's going on here, the larger issue might be, okay, so no Venezuela. If Iran falls, no Iran. If Russia's shadow fleet is getting squeezed, less Russia, where is China going to get its oil? And that might be a much larger sort of thing here.
That could be a bigger problem for China. I saw some commentary over the weekend from the various folks who like to always point blame at America for global issues, no matter what's happening or who's actually involved. But the U.S.
It's like a subgenre of political commentary at this point.
It's incredible, which is like the thought.
How can we spin this for America to be wrong?
It's like, America's setting China up to do what Japan did to the U.S. leading into World War II because we took away Japan's oil supplies and stopped selling oil to them. And so they had no choice but to attack Pearl Harbor. You see, Pearl Harbor was actually America's fault, which is
sure.
refrain that you hear from a certain genre and flavor of historians out there. Either way, though, Ilya, some of the opening quotes on the screen here, a bit softer on the equity market side. We are seeing stocks down a little bit. Bonds also a little bit weaker, though they had a nice day on Friday following that non-farm payrolls report. Ultimately, jobs were a touch softer, wages were stronger, unemployment rate was a little bit, dropped a touch. So all in all, I wouldn't say Goldilocks, but it wasn't hot, it wasn't super cold. Fed rate cut odds drop off even more from about 12%, 11% down to 5% or so.
Yeah.
Gold and silver continue to rally here as we enter this week. They are gapping open higher right now, up about 0.5% for gold, another 1.5%.
Let's get it together here. I'm still long.
So, I mean, when does this stop? I see that we have CPI coming up on Tuesday. I know we have bank earnings this week. The volatility that's kept the metals pinning higher this year, and really at the end of last year, that volatility structure remains in place.
Yeah. And I don't think the main driver here, at the risk of sounding like a broken record, I don't think gold and silver care very much anymore about what the dollar and what rates are doing, unless there is a very shocking development on CPI, on what the Fed says on the 28th when they meet. Unless there's some kind of very out of consensus jolt to policy expectations. And policy expectations have been remarkably stable. The markets have been remarkably convinced that they know what they're talking about and that the Fed will eventually see the light, and they refuse to budge, even on the side of strong economic data, like let's say the ISM services data last week. They're like, nope, we want the 2 rate cuts. We don't care what the data says. Jobs report this way, that way, ISM this way, that way. We'll show you that we want the data to be softer by rewarding or not rewarding it within the hour that it's released, maybe the next several hours. We'll show you where our preferences are. But if you think we're going to be convinced to move off our square, no. And they've been remarkably resilient on that, going back to the middle of last year. I think gold and silver don't care about this unless there is a giant dislocation. I think they're animated by a longer-term story. Deglobalization and the unraveling of global institutions, whereby you might need a non-sovereign currency in the event that your trading partners don't get along. And of course, the US and China is a great example. We've already seen that the US can say, hey, everybody around the world, if you do business with Huawei, you can't do business with the US. Pick a side. Now, you widen that a little bit, and all of a sudden, you're a country like, let's say, Argentina that wants to do business with both China and the US, or Brazil, or Turkey, any of these substantive third countries. You need to go between where you can do business with China and not run afoul of whatever US sanctions. I think that's a story for the metals that continues and isn't going away anytime soon.
Ilya, let's start to think about this coming week here. More narrative, less narrative, more price action. I see here over the next few days, the US calendar is littered with more Fed speeches, but between Tuesday and Wednesday, we're going to have our CPI report. We're going to get retail sales. We're going to find out about the health of the American consumer, which, for what it's worth, I mean, the U.S. economy is looking much better than I think anyone anticipated at this point in time.
Agreed. Yes.
Atlanta Fed right now, 5.1%. You're seeing acceleration. That's for the fourth quarter, 5.1% growth. I know the government shutdown screwed up the releases and we had everything jammed up. But if this was a typical year and now it's falling back into a typical schedule, we're talking about a GDP release that's what? Within the next 2 weeks.
Not far.
Ultimately means that we're, before the end of this month, we're going to see where 4Q was, and these GDP trackers need to be taken seriously. So we have exceptionally fast margins growth for corporations right now, Ilya. We have 5.1% perhaps. Maybe it's 2.5 as New York Fed nowcast suggests, but 10 years ago, 5 years ago, anyone would have killed for anywhere between 2.5 to 5% real growth after the secular stagnation of the post-global financial crisis era. Okay, so what's the story with CPI this week? It looks like the Fed meeting is a done deal for January.
Yes.
Do we care what happens here?
I don't think the bogey is the January meeting. I think if the bogey was the January meeting, we wouldn't care, but that just means that the bogey isn't that. Because of course the markets care about what the Fed is going to say. The question is, do they care about what the Fed is going to do in January? No. It's a foregone conclusion at this point what the Fed is going to do in January, I think. The question really is what happens next? And interestingly, but by the way, take a look at the board. April is no longer where the cut is.
The market, by the way, is fully convinced that the second Powell's gone, the next Fed chair
now they're
is going to have to cut.
Okay, in June. They'll do it in June.
Well, Trump has said
it was April last week.
Trump has said that, his next Fed chair pick, which could be coming this week or next week or the week after, right? That he expects the next Fed chair to cut rates immediately. So I think it's fair to say that if it's Kevin Hassett, Chris Wall, anyone, Kevin Warsh,
in fairness, Waller, right? Markets thought it was going to be April last week. So it's not like the market, and it's not like the markets don't know this. So I think they know that the cut is coming, and they think the setup, we're going to have this emergency liquidity until tax day. When's tax day? April. Okay, this is the post-April meeting. Let me figure this out now.
Right. Then the liquidity support goes away. The Fed cuts. Trump has this new guy in there. Speaking of Trump, I know it's not on any economic calendar, but you're going to see that the Supreme Court's releasing their decision on Trump's tariffs this Wednesday, which is interesting.
Is it really going to happen this time?
We'll take them at their word. But if it was Friday, given how they release those decisions over the course of the day, it would have been interesting had they released the decision late on Friday. Because then you have the weekend to digest the news. Which would have... Right,
back to back with CPI.
So we're gonna have Tuesday CPI, which last time around was a bit softer, didn't really move the market. Wednesday tariffs. Which one matters more this week?
I think yes.
Okay.
I would say the issue with the tariffs is increasingly a done deal. I think people know that these tariffs are going away and are going to have to be redone. But I don't think anybody thinks that anything is going to happen in a hurry. I don't think anybody thinks they're going to get redone quickly, that this is going to be a long morass of work, and that nothing here is an immediate fire. I think chances are the Supreme Court doesn't decide, this is unconstitutional in a way where you have to stop today, because that would be chaotic. So they probably create some kind of an off-ramp with a period of time. So if you do that, then you have a situation where the CPI becomes much more real. And the two sort of feed on each other. Because ultimately what a canceling of the tariffs would mean is uncertainty about how they're going to get reconstituted and under what authority. And there's options. And some of those options take longer than others. And that just tells the markets we want the protective blanket of cheap money sooner. The more uncertainty there is, the more cheap money the markets want. It's why they want the cuts. I don't think they know what risk they want the cuts to insulate against. They just want to insulate against risk because everything looks shaky. So to my mind, the two are intimately connected. So if you get a CPI report that's a little on the hotter side, and then you get a canceling of the tariffs, probably the worst of all worlds as far as risk sentiment is concerned.
So we have our macro risk for the week. We have our earnings finally coming up. 5% of S&P 500 companies will be reporting over the coming days. I see that it's the banks, because while there is an earnings report on Monday that technically is there in SiFi Technologies, SIFY, I don't think anyone's trading that because it's a market cap of barely over $1 billion for an earnings release. JP Morgan, though, Tuesday, along with Bank of New York Mellon, Delta Airlines, Wednesday, Bank of America, Wells Fargo, Citigroup, on Thursday, TSM, Morgan Stanley, Goldman Sachs, BlackRock, which is not the same thing as Blackstone. I see that's been getting a lot of flack and confusion recently about private home sales and absorbing the market. PNC, STT, State Street Corporation, M&T Bank, MTB, those are all on Friday. Ilya, the banks have been really strong this year. Maybe it's because they see the cuts coming. Maybe it's because they see a really, really strong set of economic data in the rearview mirror. 5% growth. Everyone can pay back their loans at these levels. That kind of growth's out there. What's the worry? Are banks going to be a catalyst that this market needs to give us the hope, the belief that this is not just an AI-driven rally, but there's a real economy underneath all of this?
Well, I think you're going to have to see really how all of the larger macro situation works out here. Because if you're the banks, you're sort of at the forefront of what seems to be happening on the policy side, kind of in aggregate. And the consumer seems to be relatively strong. I mean, we just saw very kind of heroic looking consumption numbers, let's say, for the third quarter. When we look at the PMIs for what happened through the government shutdown in the fourth quarter, the S&P Global numbers show you that there's been a little bit of a dent, but ultimately you're back to average from relatively high levels, and the ISM numbers are just explosively supportive. So when you look at all of that together, you probably get a fairly decent consumption quarter in the fourth quarter, give or take. So what are you looking at as far as policy going forward? The tax breaks from the big, beautiful bill, whatever it's called, that's still working its way into the economy. That's going to be supportive this year as a fiscal tailwind. The Fed is going to cut at some point by some amount, but it's certainly not going to hike. So conditions are going to get looser, not tighter. If you're the banks and you're sort of cyclically sensitive to the churn of capital, it doesn't look bad for you.
Doesn't look bad for you right now. The banks are all in pretty good shape. I was going through some of the tickers there before, Ilya. We could look at a JP Morgan, which is effectively sitting right up at highs, having broken out on a really nice little breakout there. We hold 320, 325 over the course of the next few days. Looks like support's in place, and this thing has finally shaken off a multi-month consolidation, which, Ilya, just from like a technical perspective, I see a little bit of a flag that's been formed here. Maybe that's just me, but that looks like a bull flag. Goldman Sachs has been really strong. Bank of America has been really strong.
It's not dissimilar, actually. There's a slightly earlier stage breakout like this in the Russell itself, where it's sort of similar, where you have this clean stair step higher and you've just taken out the high and you're sort of at that first step of what would be the next leg. I'm going to be looking very closely once we get liquidity back into this market with the US Open. I'm probably not going to jump at it with anything like a futures contract, just to keep things small, because we are at some pretty heady levels here. But IWM, if I can size a call vertical there that makes sense, I can see that.
Yeah, the Russell last week closes on strong footing, where, quite frankly, breadth has been picking up, and it looks like it's been improving over the past several weeks. I think as much of this market having a reputation of being one built on concentration in the AI names and the Mag 7 names. You look at last year in the Mag 7 names, 2 of the 7 finished green.
Yeah.
And if you look at how the earnings profile of those companies improved, right? It was the earnings growth that powered the move higher, but they actually had reduction in their PE ratios.
Yeah.
Over the course of the year by about 5. I think the PE ratio was about a 5% loss in the total. So there are some, there are some bright spots. I continue to look to RSP, the equal weighted S&P 500, which is at a new all-time high. I look at small caps soon, what they're doing. So we have some nice setups there. I'm curious, Ilya, what are we doing different next week then? If we have all these earnings, are we changing our posture? I think is a question a lot of people would find themselves asking here. I'm not just because I'm waiting to get on the platform, but it's because I also don't think that there's a reason to get out of the market on the long side. I'm still leading long ES vis-a-vis the 70, 50, 70, 100 call spread. Also an MES position. Likewise, a smattering of long deltas in Broadcom, Meta, Google, a BTU, Peabody Energy, which started to break out again, which was one of our trades from last summer, Ilya. We
Mhm.
happened to reload last week and look long again for move up into the 35.40 call spread, which had a nice quick $3 move. So there are a lot of things working. The gold and silver moves continue to work.
Yeah.
I think this is one of those Jesse Livermore times, Ilya.
You just got to
Make
sit on
your
your hands
money.
sometimes.
Got to sit on your hands sometimes and let the market do the heavy lifting. So we have our setups. We have our low volatility. We continue
About
to
the
have
only thing
our
I'd
low
add
trading
to
volumes.
the list that you just trailed off. I mean, I'm still, in fairness, on the short side of the S&P and NASDAQ because they're still not back through their highs against which I'm short. So I'm holding those. They'll work or they won't. But I'm out of the Russell. And at this point, I'm looking to get long. So that's my sort of most meaningful change. I've started to really pile in long into the US dollar because I think we're seeing something of a turn here. I am now short the yen. I'm short the pound, the euro, the Aussie. With our friends at Tasty FX on the spot side, I am short the Singapore dollar. I'm short the Kiwi. So I've laid it on thick on the long side of the dollar here because it looks like we might be looking at something of a change of gears.
Yeah, the dollar did turn the corner potentially last week. I don't have it up here right now, but when we broke through 98.75 or so, we also broke through our 50-day moving average.
That's where I started to add to that long dollar against euro position, which is basically what this is. The dollar index is basically euro dollar upside down.
And when you look at the technicals in the euro, in the pound, and the yen, all of them have moving average profiles, right? Where the 5 is above the 1 month, the 21, which is above the 50, in the dollar's favor, and they all have those positive slopes. So dollar yen trending high. If you look at like dollar euro, dollar pound reverse, all have those similar momentum profiles. The yen to me is the most interesting one, of course, because as we continue to press up here, we're starting to think about pushing through that 2025 high, and then those June, July 2024 levels where we were pushing 160 brought in a whole bunch of intervention risk. And we've had that conversation a lot here, Ilya. So if I'm a dollar bull, I feel like the most difficult place to play this is probably in the yen right now. But as the pound starts to pull back in here a little bit, as the euro keels over a bit right now, I did see a really interesting post this weekend calling what's happening the euro to be a head and shoulders pattern, left head curving out the right.
Yeah.
The dollar, that's interesting. Everyone was so down on the dollar last year.
Hasn't made a low since July.
Yeah, but it hasn't made a low in 6 months.
With all this easing, with the Fed finally relenting on rate cuts, can't make a new low since July.
Silver here, up above 81 again as we wind down the show, Ilya. I'm going to rename my firstborn son Silver, I think, given everything that's going on here. But I would remind people, as I've seen in the comments, is another CME margin hike coming? As much as I'd like to think that the Futures Power Hour, sponsored by CME Group, affords me some information that I could pass on, I have no idea what they do. And I do think it's a legitimate thing to be concerned about. But just the last point there, the margin levels have been cut down twice. They've been increased twice, excuse me. The leverage levels have been cut down twice.
Yep.
And it's a lot. These were already smaller leverage levels than we were seeing in previous major run-ups. So I don't know if standing in front of this is a great idea, but you and me have been gold and silver bugs for the better part of the last almost 3 years now, 2 years.
Yeah.
So maybe don't trust us if we're saying ignore the bears, but I think the price action speaks for itself. We're going to have the platform.
So far, so good anyway.
Momentarily. I am seeing some from folks here on our side of the table. This is actually not a Tasty issue. This is coming through one of the data providers and one of the clearing firms. So it's not just going to be us. You're going to see this elsewhere too. It is being resolved. I will tweet out later on, and I know that Tasty Live show handle will tweet out later on when we do get the platform and everything back up and running. But for now, Ilya, we're going to end first call with stocks a touch weaker, bonds mixed, gold and silver running higher, oil up 50 cents after the weekend's news in Iran. We do have, again, CPI Tuesday, tariffs Wednesday, and then we're going to have all those bank earnings over the course of the week. Program resumes at 8 a.m. Eastern, 7 Central. You get the Batman, you'll get Veneta. We'll kick the week off right here on Tasty Live. So, Ilya, hope you have a good rest of your night. Good luck trading. And to everyone else, thanks for tuning in and thanks for trudging through those tech issues with us. We'll see you bright and early tomorrow morning.